Hello, it is Friday, which means it is time for the latest edition of Risk and Rewards. John Authers here with me. I'm Lisa Abramowicz. And when we talk about the main theme of every week, we tend to agree. This week was no different. The main theme was, why are bond yields so low? If the inflation reads that we keep seeing coming out, whether it's the CPI, PPI, whether it's the University of Michigan expectations that came out today, how can they be so high and Treasury yields be so low? John, this to me was the underpinning conundrum the entire week.
Yes, there's just no question. The only question, unfortunately, is coming up with an answer to it. There are any number of answers that might go some way towards it, and there's also any number of people out there with very strong confidence that they know the answer. There is nothing that fully satisfies me. It's one of these very awkward situations.
Full stop, by the way, but carry on.
But it's one of these very awkward situations where, it's obviously my job and your job as well at times to give people an opinion and give people something to think.
Okay, so what's the opinion? What do you think? I have an opinion.
My most honest opinion is that I genuinely don't know. If you want, and that's because I have never lived through a pandemic that was worse than anything in a century before, and I haven't witnessed the effects of that, and we just don't have good enough precedents for what's just happened. My opinion, if I have to come up with one about the market, is plainly at this point, whatever reason bond yields are doing what they're doing, they shouldn't be this low. I am very confident that the idea that this inflation really is thoroughly transitory is being overpriced. That chance of that happening is being overpriced.
I'll present the alternate argument. And actually, there were a couple of interviews this week that I found fascinating and really important. First of all, Stephen Major, who's head of interest rate strategy over at HSBC, who's gotten it right time and time again. And then Robert Tipp over at PGIM Fixed Income. Both of them came out and said it's highly likely we have seen peak of Treasury yields so far this economic cycle. They also, Robert Tipp went so far as to say we've seen the peak in the yield curve in terms of how steep it got, and then will continue to contract. What they're looking at is if it is transitory, or even if it's got a little bit more persistence in the near term, it slows growth. And frankly, we get back to that sort of slow growth narrative with even more debt, which typically is a recipe for lower interest rates because we cannot afford interest rates to go higher. And on top of all of that, and Robert Tipp raised this point today, and I think it's incredibly important, people are pulling back their expectations for fiscal stimulus, right? So people had earlier been thinking, oh, we might get $5 trillion, $6 trillion of fiscal stimulus. Everyone wants to spend. Well, not really. I mean, we're not seeing it. And we don't have any kind of agreement that seems feasible beyond the $1 trillion bipartisan agreement. This is a significant underpinning of the long view that nothing has changed. If anything, we just have more debt. We have an older population. We have less immigration. I mean, there are all of these aspects that make sense to me on that front, regardless of what the Fed does.
No, I certainly agree with pretty much everything that you've just said. All of these forces are genuine. It's just that some forces, there could be different genuine forces that push things in different directions. Yes, it is certainly possible that inflation carries the seeds of its own demise. I mean, this is particularly true of commodity inflation. If oil prices go up very sharply indeed, then that means for many people that they then can't spend as much money on other stuff. So it's transitorily inflationary, but is actually deflationary over the next medium term. That is true. Carry on, Lisa.
Well, and you could see. Well, I just wanted to sort of support that with the University of Michigan survey that came out today. And that's exactly what it showed. Individuals were less confident and much less confident than people had expected them to be because of higher inflation. They were reducing their purchases of high ticket items, particularly on the higher income level, where they had more discretion over these things. On the lower income level, people felt the pain of higher food prices, of higher gas prices. It was actually a real issue, which made them pull back a bit. And we've seen this in lumber prices. They've come down because people reduce their purchases. At what point does the hotter inflation runs now create an even slower growth picture long term, whether the Fed responds too quickly or whether the Fed lets it run and then actually reduces growth?
I mean, bear in mind, I mean, this is true. And there's, I mean, I guess particularly the Austrian school of economics, the idea that you just don't touch anything and all of these things do ultimately correct each other, has some validity to it. But we do have this imponderable of exactly how will people behave. If you think inflation is coming and you do have some money in your pocket at the moment from, for example, a stimmy check, you are more likely to spend it earlier rather than later if you are bothered about the effect that inflation is having on you. Ergo, inflation goes up. Also, if you are in a situation where a lot of people have decided they're going to throw in the towel on the labor market and simply retire coming out of the pandemic, and you are moving into a stage in the demographic cycle where there are fewer workers, the working age population is a smaller proportion of the total population, so your negotiating power is increasing a bit anyway. The fact that these things are bad will make you more likely to bid up wages and more likely to do it successfully. Thus, you could have an argument for the kind of undulations that happen when the cycle is working as you hope it will in, I guess, the 50s and the 60s. You also have an argument, though, that this could turn into some kind of a version of the 70s. Not saying the levels are going to be as bad as they were in the 70s, but of stagflation with a wage price spiral and people spending money like there's no tomorrow because they're worried about inflation.
I like your optimism.
Thank you.
I wish I could buy into it. I mean, honestly, there were signs, not to be all bearish and negative, but to be all bearish and negative. There are signs. You are right about this. And I actually think that this is one of the most underappreciated aspects of just the wage inflation that we are seeing, whether it's McDonald's or whether it's Walmart or Amazon paying people more. And then you have BlackRock coming out this week. And I know that everyone's very concerned about BlackRock employees and what they're getting paid, but their base salaries increased by 8%. And this was a directive because CEO Larry Fink was saying, look, prices are rising. Inflation is here to stay. And post-pandemic, this is what we're going to do.
Yeah. But if you also look at the Atlanta, just one number I think is of interest. If you look at the Atlanta Fed wage tracker, which is this nice real-time look at wages, and they cut and dice in a lot of ways, the lowest skilled category and the high school diploma or less categories are both seeing the strongest wage inflation in a decade. They are, I mean, they're still not at any particularly special level, but we all know it's the trend that matters. And the people who have done really badly for a long time, again, this isn't necessarily bearish. It could be great for social harmony that a lot of the people who've done terribly in the last decade or so might be beginning to get a slightly better deal. That's good. But if you're in the bond market, that means you should go for more inflation, that the way that the rest of the market will have to adjust for the fact that that more people are getting a slightly better deal at their place of work.
Well, there's a conundrum though here, because if it's a one-time price hike, if it's a one-time wage hike, it might not have really any material long-term effect on bonds, right? Because if it isn't the pace of increases, then it's a one-time reset as we reopen here. People are getting paid more, prices are higher. Great, everything's been moved up, but it doesn't necessarily mean anything persistent, right? So we can go back to that transitory kind of argument, albeit with a little bit higher wages and albeit with a little bit higher prices. And that still could mean the pace of growth is very slow. I mean, honestly, the reason why this is so important, and we started talking about how every week we seem to just dig into these sort of microeconomic issues, but this matters for every call in every asset class. And I think that that's what we're seeing in equities with that rotation back into big tech, where people are saying, we just want huge cash flow because that's all that's going to make sense and yields are going to stay low. And there really is a question of whether that's overplayed or whether it's boring, but that is the bet going forward.
Well, it is the bet going forward. I mean, what I cited some research this week. If you look at, if you divide the stock market, this is global as well, not just the US, into quintiles according to how much they correlate with bond yields. then the stocks that do well when bond yields are low and falling are doing the best so far this year. And the ones that do best out of higher rising bond yields are doing worse. Now, that's not just people in the stock market, or in fact, it's primarily not people in the stock market making a bet about where they think bond yields are going. It's that their take on the economy, their take on these companies they are following is such that they are thinking we're going to have the conditions where bond yields will go down. So it isn't that I have to admit, having being strongly of a mind that quite a lot of what's going on in the bond market in the States is about technical factors. It's about, we don't need to bore people with stuff like pension managers catching up with their bond allocations after buying equities early this year, all that kind of stuff. There plainly is something more to it than the technicalities of the bond market, which I have to admit affects what I still think is ultimately my central view, that the bond market is probably going to step on a rake and see yields go back up again.
Okay. We only have about 4 minutes left, but we have to do our risk and reward back and forth. And so let's start with potential risks. Can you give us a sense of where your mind is at this week?
Where's my?
With the markets, we're talking markets, nothing else.
At this point, okay. I had tickets to go and see the Yankees play the Red Sox last night, and it got cancelled because of COVID. And I also can't go home to see my parents without getting a PCR test and doing quarantine once I get back in England because of COVID, specifically the Delta variant. I don't want to sound alarmist about it, but I think the risk, and this is a good reason, incidentally, for lower bond yields for longer, is that the risk that the pandemic does actually really drag on in an irritating way and stop us really reopening and rebounding is underestimated at present.
And I would argue the flip side, the bond market story of that, it doesn't seem like from the interviews that I've had, the market is positioned for substantially lower treasury yields, right? I mean, where we are, people are kind of questioning if this makes any sense whatsoever. But what if they were to test new lows, right? What then would people be saying? And how disruptive could that be? I mean, at a certain point, stocks stop rallying if yields go that low, because there is a signal there, especially if accompanied by COVID. All right, how about reward?
How about the best potential reward out there? Okay, I'll give you two very quickly. One is, given that I've spent so much time arguing about whether there's a hawkish or a dovish mistake by the Fed as the biggest risk, maybe there's a big reward that none of us are noticing from the Fed actually successfully navigating us through this nervelessly and perfectly. I've heard nobody suggest that this could happen in weeks. So just maybe the Fed will get it right. If you want to bet that things are getting better and that the bond market is wrong, I think emerging markets have underperformed, depending on how you measured it, but they've underperformed developed by about 10%, even if you exclude China this year. That does look overdone. I would dive into emerging markets if you want to bet that the bond market's wrong.
So my call is literally the opposite, but it's interesting because it's basically
Dr. Cisco and Ebert at last. Carry on. What's going on?
Well, you said, emerging markets could have potential upside. I don't see how the Fed hikes rates or tapers behind any other bank, right? I don't see how any other, like whether it's the ECB, whether it's the Bank of Japan, I don't see them becoming more hawkish before the Fed sets that tone. So if the Fed has to be the first mover with respect to starting to tighten policy, by nature, the dollar will strengthen, and that will offset the emerging market bet. And that's actually, I think that the dollar strengthening is something that perhaps still maybe, I don't know, it looks like it is on a certain trajectory. And I understand from a monetary policy perspective why it could continue. I'm not saying it will, but the global reflation trade only goes so far with the Delta variant. And then add on top of it, a more hawkish Fed that would have to be the first mover, or that likely will be the first mover. And that's what I'm kind of struggling with.
Well, there's a few emerging market banks that have made moves in a sort of tightening direction already. But yes, you're right. There would be a cue from that. Okay, yes, that's a valid point. I guess it's just if the strength of the recovery overwhelms the aspect of the necessary tightening that would go with the strengthening of a recovery. As the two go together. And again, markets are supposed to be about counterbalances, about checks and balances, like American democracy. They can actually work that way.
Absolutely. But to your point about emerging markets, one aspect is that there is an underinvestment in emerging markets credit in particular. So, to your point, if it does look like some of these countries are more creditworthy, it could be a positive spot should the reflation trade take over.
If the kind of reflation trade people truly believed in 4 or 5 months ago happened, which was obviously a good reason to buy EM, actually does turn out to be true, then the fact that EM has had a bad few months since then, yes. We more or less agree on that, but I agree with you. Yes, there are certain risks with the way the monetary policy dynamics and the FX dynamics work out for taking that. You would need to have a very strong stomach for doing it now.
And I will forgive you if you call me Eeyore or just General Bear. I'm okay with that because, frankly, I understand that I typically am a skeptic in a lot of different ways, and it isn't always the most optimistic. Anyway, that does it for us. We're unfortunately out of time. I love speaking with you, John. Have a wonderful weekend, and to everyone who's watching, have a great one.